Downbeat second quarter GDP data proved that Jerome Powell was wrong, saying that he did not see any signs of a recession in the United States. Gross domestic product fell by 0.9% on a quarterly basis, while economists predicted a gain of 0.6%. Thus, the U.S. economy contracted for the second straight quarter from April to June. Although a recession is usually defined as 3 consecutive quarters of negative economic growth, it's already clear that the U.S. economy is steadily tapping into it. This means that energy demand will gradually shrink. This is what caused a slight decline in oil prices. Nevertheless, the asset is still trading above $105 per barrel. Fears of energy shortages continue to support crude prices. Moreover, a global energy crunch may well be even graver. However, it's not yet clear what will happen to the balance between supply and demand in the oil market. This, in turn, does not allow investors to decide on the quote's further direction. That's why the most likely scenario for the near future suggests a range-bound trading between the levels of $105 and $110 per barrel. According to the trading chart, Brent crude oil futures added about 15% over a 2-week period of the corrective move. However, the asset ran into the resistance level of $110 per barrel, at which the volume of long positions decreased. To extend gains as part of an upward correction, the price needs to consolidate above the key level of 110, at least on the forward chart. And in this case, Brent crude will have every chance of heading towards $115. Otherwise, rising short interest may return to quote to the level of $105. The risk of protracted recession coupled with a high inflation forced investors to shift their focus to safe haven assets, including gold. Against this background, the yellow metal came close to the mark of $1,775 per troy ounce. Thus, gold prices have gained over 2% since the beginning of the week. Moreover, prices are likely to advance to $1,800 amid growing fears of a recession. Such a strong corrective move may well push the asset into overbought territory in the short term. However, a steady increase in the interest rates by both the United States Federal Reserve and the European Central Bank will inevitably have an adverse effect on the gold prices in the medium term. In this regard, traders began to analyze possible scenarios around the resistance level in the area of $1,780 and $1,800. The volume of long positions may decline. This will lead to a shift in the market sentiment and a subsequent downward reversal. Speaking of the ruble, the Russian government is still considering reintroducing the country's budget rule, which will allow the Ministry of Finance to buy foreign currency via market interventions. Amid these expectations, the ruble is standing still. However, market participants appear to be running out of patience. This is indicated by the dollar's increasingly frequent attempts to fall below 60 rubles. If the authorities drag out this decision, the Russian currency will most likely resume gains and hit for the level of 50 rubles per dollar. And that's all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you soon.